Why do I lose big even when I use small lots? That's the question you've been asking yourself quietly. And tonight, I will not sugarcoat it. I will show you why that question keeps haunting you. Here's the truth. Risk isn't what you think it is. Until you face this, you will keep blowing accounts no matter how small you size your trades. Welcome to intentional trading. We don't motivate traders, we transform them. This is not another stay disciplined, manage your emotions channel. This is where structure rules, where we dismantle illusions, and where we train you to become intentional about your trading identity. Listen carefully. What I'm about to say might sting. Most traders believe risk is measured by lot size. They think if they keep position size small, they're safe. They believe cutting leverage or trading micro lots automatically reduces the danger. That mindset is an illusion. You are measuring risk by size when in reality, risk is probability. You are not trading numbers on a screen. You are trading outcomes that repeat, patterns that recur, probabilities that either align with structure or collapse into chaos. That is the real battlefield. Traders enter positions thinking, it's just point or one lots, what could go wrong? Everything. Because the danger never came from your lot size, it came from the fact that your trade had no structural probability attached to it. Let me be clear, risk is not simply how much you can lose in one trade. Risk is how consistently your model can define and repeat an advantage over time. If you do not have that, no small lot can save you. You will bleed out slowly instead of blowing up quickly. Either way, you lose. Think back. How many times have you told yourself, I'm playing it safe, and yet your equity curve still points down? You were safe, but you still lost. That is because you confuse safety with survival. In trading, safety is not in the size, it is in the structure. The structure defines probability, probability defines outcome, and outcome defines survival. Without that chain, you are not safe, you are merely delaying destruction. Thousands of traders sit in forums asking, what's the best risk management strategy? They want a magic percentage of account balance to risk per trade, 2%, 1%, half a percent, as if the percentage itself guarantees safety. If your model is flawed, even risking half a percent per trade is suicide by 1,000 cuts. You will not blow up quickly, but you will watch your account erode, slowly, painfully, consistently. The market punishes the same mistake whether you risk 10% or 0.5%, because probability does not care about your comfort. It cares about structure. That is why some traders can trade larger positions and still grow, while others use microlots and still lose. It is not the size, it is the probability that size is attached to. What does this mean for you? You have been fighting the wrong battle. You thought your enemy was leverage. It was not. You thought your enemy was big lot sizes. It was not. Your real enemy is misdefined risk. Risk is not what you see in the lot size calculator. It is what you cannot see unless you build a model. The hidden danger is not the point 0.1 or point 0.5 on your screen. It is that you have no repeatable process giving those numbers meaning. Picture this. You are crossing a bridge. If the bridge is structurally flawed, does it matter whether you carry a heavy bag or a light one? No. You fall either way. The weight only determines how fast you collapse. The collapse is guaranteed. The bridge is your model. If your model is broken, no matter how lightly you step, you will eventually fall. Traders do not fail because of step size. They fail because they never built the bridge. Review your trading history. When you risked small and still lost repeatedly, did the emotional pain feel any less severe than when you risked large? Likely not. Frustration piles up until you increase size to make back losses, and that is when the account implodes. That spiral is not random, it is structural. Small lot sizes buy time but not safety. Only structure buys safety. Risk is structural. It is embedded in your design. It is the DNA of your trading approach, not the cosmetic of your lot size. If your design does not define risk through probabilities, you are not managing risk. You are decorating chaos. Chaos decorated remains chaos. Make this concrete. Suppose your strategy has no tested recurrence. You do not know whether your setup wins 60% of the time or 20% of the time. You judge by feel. You enter with 0.01 lots and think it's tiny, manageable. Wrong. The true risk is trading without expectancy. When you trade without expectancy, every trade is a coin toss. That is not safe. It is slow suicide. Compare that to a trader with a tested model. He knows his setup wins 55% of the time with a 201 reward to risk ratio. He risks 2% of capital per trade. That is larger exposure than your micro lot gamble, but he is safer. Why? Because his risk is probability defined, structure validated, and expectancy driven. Your small size was never safer than his larger size. It was simply weaker. This is the paradox most traders miss. Safety is not minimizing size, it is maximizing structure. If your model is strong, you can scale. If it is weak, you are doomed at any size. So when you ask, why do I lose big even when I use small lots? The answer is brutal. Small lots cannot save a trader without structure. You were never safe to begin with. Be honest. Is this why you feel stuck? You have tried smaller positions, wider stops, tighter stops, trading fewer pairs, switching time frames. Nothing works. You always end up losing equity, confidence, and time. That is not bad luck. It is the inevitable outcome of misdefining risk. You are treating the symptom while the disease spreads. What is the cure? Redefine risk as probability. Shift your thinking from how much can I lose on this trade to what is the expectancy of this setup over 100 trades inside my structured model. That is the professional lens. That mindset turns chaos into intentionality. Here is what you must do. Stop obsessing over lot sizes in isolation. Build a model that defines setups with statistical recurrence. Backtest, forward test, and review. Track probabilities. Measure not only win rate, but expectancy. Design an approach where risk is embedded in process, not improvised in the moment. Then, and this is crucial, trust the model. Trade it repeatedly, consistently, intentionally. That is how risk becomes structural instead of emotional. That is how you stop bleeding out and start compounding deliberately. This will require work. It will require tearing down illusions and reconstructing your identity as a trader. But that is preferable to living in endless cycles of failure. You already know the pain of doing it wrong. Now taste the transformation of doing it right. Do not merely nod and move on. This is your moment to shift from survival thinking to structural thinking. Build your bridge before you take another step. Stop decorating chaos and start designing intentionality. The market does not reward the cautious, it rewards the structured. If you are ready to build that structure, you are in the right place. This is intentional trading. We do not just trade, we design. If this truth resonates, subscribe now. We are not done, we're just getting started.